What's up, guys? Welcome back to DCA. So, obviously, the market sucks right now. There's nothing else to say about it. So, we've been selling off. We're looking at the weekly chart for Bitcoin here. We've been selling off for 6 straight weeks now. Now, if you take a look at this move, we've only, went down around 25, 26% in this single downtrend that we've been in ever since back here, the last week of March. We've only gone down around 26%. So it's not the worst move we've ever seen. We've seen moves where we go down 25% in just a week or two. For instance, if you take this move that we saw back here in, back in May of 2021, that was a much more severe move than what we're seeing right now. That was a 50% move in just 2 weeks. So it's not so much the extent of the downward move, it's the relentless nature of this move. This move to the downside has just been absolutely unrelenting. If we take a look at the number of days that we've been essentially doing nothing but moving down with just a few, upswings, we're talking nearly a half a year here. So this dates all the way back to November. So somewhere around 170 days or so. So we're literally talking about nearly a half a year where, we've only had 8 weeks in the last half a year where we've had an up week. So, this has just been an absolutely unrelenting downward move in this market. Now, let's just talk about what's going on. So, I keep harping on this, but that's just because, no one's really been talking about it. I think people are starting to talk about it now. Now it's starting to become mainstream, like we said, when it's so obvious that even your moon boys know about it. You probably jumped on the bandwagon too late once the moon boys know about it. Once they know about it, that's it. Everyone knows about it because those guys don't know anything. So, let's just break down what's going on right now. So we've talked about a lot on this channel. We've talked about inflation. We've talked about interest rates. We've talked about the Fed. In fact, I'm going to leave a link in the description below to a video where I discussed, and this is maybe a month or 2 months ago, maybe even more at this point. I'm not exactly sure when I released the video, but it was within the last couple months where we talked about the Fed and inflation and interest rates and how the actions that the Fed takes sort of influence inflation overall and how them changing interest rates changes inflation and how supply chain issues affect inflation. So we talked about all of these things in a video. And I think if you're invested in this market, you need to understand these things because that will help you understand the gravity of what's going on right now. So just put it all in perspective. We had a global lockdown. This is typically for most people a once in a lifetime event. It's a once in a lifetime event. It's something to this magnitude will likely never happen again. This is followed by a reactionary response from central banks globally. This leads to the massive level of inflation that we're seeing now, but not just that. And that's important. And that is going to be critical here. It's not just the Fed or, the central banks around the world printing money. It's the supply chain issues that go along with it. Because inflation at the end of the day is influenced by multiple things. It's not just the money supply. And this is what people don't understand. If your money supply increases, that's going to cause inflation. But if there are less goods to purchase because of supply chain issues, that too is going to lead to inflation. The simplest example is think about used cars. If you've been out to buy a used car lately, think about how expensive a used car was right now. Or, think back over the last year or so. And it's been, extravagant prices for used cars. And that all circles back to the fact that because of the lockdowns in China, in manufacturing countries, and, we're talking about 2020 and 2021 lockdowns here. We're talking about events that were going on last year or a year and a half ago. These events led to these massive supply chain issues. Okay, we haven't even got to where we're at now. So we have this pre-existing issue, this pre-existing supply chain issue. Then you pile on top of it the fact that at some point, Russia invades Ukraine. So now you have a major fuel crisis for many places in Europe, okay? Because Russia is denying fuel to these countries. This wasn't like something that places, countries were planning for. They weren't planning to have fuel reserves in case Russia invades Ukraine. So you have that going on. Then pile on top of that, on top of all of these issues, you have at the same time new lockdowns in manufacturing districts in China. So you have a layer upon a layer upon a layer upon a layer of negative events leading to massive inflation. Okay. So when you take all of this, and you consider that now the Fed in the United States, the biggest economy in the world, is raising interest rates, creating a situation where it's more expensive to borrow. It's more expensive to take money and to invest it. It's taking money off of their balance sheets. They're taking money off of their balance sheets. They're raising interest rates. So they're doing two things at once. They're making it more expensive to borrow, which would then go to investments, which would go to spending in the economy. Think about things like taking a loan out to buy a house or to buy a car, etc. That is now more expensive. So in other words, they're pulling money out of the economy at the same time that they're, making it more costly to inject money into the economy. And this is all to combat inflation. Okay. So the Fed can control that. They can control the money supply. And this is what we talked about in this video. So if you don't understand all the inner workings here, I would check this video out because we explain it step by step. All right. And you have all of this stuff going on right at the same time. And we're not even feeling the impact per se from things going on in Russia and China right now. Or sorry, things going on in Ukraine and China, the things that are occurring right now. These impacts don't happen immediately. A lockdown doesn't happen in China and then it's felt in the, the statistics of the economy immediately. This takes time. So we're seeing this place where you have people telling you that the riskiest risk asset, cryptocurrency, Bitcoin, your riskiest asset is going to, we're at the bottom. This is it. We're going to go up from here. New all-time highs right around the corner. Look at the supply on exchanges. Like that's the only metric that matters. Okay. So these people are just, to me, it's crazy to sit here and think that people are just FOMOing in. No one is FOMOing into crypto right now. It's just not happening. Anyone who is telling you that is maliciously, deceiving you. They have to be, or they're a moron. Those are the only two options here. No one is FOMOing into crypto. Who is FOMOing into crypto? Are you FOMOing in right now? If you are, good luck, friend. I just think it's, when you look at all of these things, anyone who is telling you that the market is primed right now to turn around and go to new all-time highs, it's insane. That's all I can say, guys. It's insane. So with all of that said, let's talk about the potential for me being wrong here, for me just being totally off base of what I'm saying. So we actually saw back here in July, that this market went up. If we just measure this move right here, when we hit this bottom at around, the mid 29K level. Well, this was actually the bottom over here at 28. But when we got down to 29, the market sort of turned around here in July. And we went up with just Bitcoin. This isn't even including altcoins, 134% for Bitcoin. Okay. And when you look at this move, when you look at the dynamics of this move, and we talk about things like active addresses, when we talk about things like volume, when we talk about, all of the standard metrics that we see in the setting of a bull market, like we saw here, or 2018, or even 2014 for that matter, or 2013, we always see that the market acts in a very particular way. It acts in a way where, there's strong retail interest. But we did not see that here. We saw a very peculiar move where we moved up to the upside, and it was not accompanied by any of the normal healthy metrics we expect to see. So this was an unexpected move for a lot of people, myself included. I didn't, I was looking at things and it kept going and kept going, and, just sort of thinking, well, maybe this is a new behavior of Bitcoin that we've never seen before. But in fact, it wasn't. Okay. So, this was an unexpected move where we went, on this wild run from July to November. So this doesn't mean, everything I'm saying here doesn't mean that the market has to right now, head down to 30K, down to 20K, whatever, wherever the bottom is. We're not even going to try to estimate where the bottom is going to be. Okay. We're just talking about what's going on right now and how you need to consider Bitcoin and the crypto market as an investment. So we know the markets, we know that the markets are looking ugly right now, but the markets can act irrationally in the short term. Just because things are looking bad right now doesn't mean this couldn't turn on a dime here, especially now that we're down at this, this trend line, this upwards trend line that we've been forming. We're still technically, if you want a little bit of hopium, we're still in this channel. We're still in this upwards channel. And whether you want to go from closes or, to wicks, whatever. Actually, if you go from closes, daily or weekly closes, we've actually broken below the trend line. So, if you're just looking like that, we've broken below this trend line. Now, if you just look from the wicks down, then the trend line is still actually intact here. So, depending on how you want to look at this, if you want a little bit of hopium, that's about all I'm seeing. That and the Bitcoin on exchanges. And I haven't even checked today or, the last couple of days, to be quite frank, to see if it's still going down. But other than that, beyond those couple facts right there, there's just a lot of negative, emotions in the market right now. But like we're saying, markets can react irrationally in the short term. So things could be looking ugly and we could go on a pump from here as participants in the market try to squeeze out, some last bit of gains before things sort of give way. And I think that's kind of what you're seeing right now. It's why things aren't sort of giving out more than they are. People are trying to, the big time players, I think, are not trying to essentially not tank the market. Because at the end of the day, if they tank the market, when you have the kind of, the number of assets they're holding, they need exit liquidity. So if they create mass panic, then they don't have any exit liquidity. And then in that case, they're the ones holding the bag. So this is sort of the base layer of what we're talking about here. Now let's come over here to the Bitcoin comparison with the Nasdaq. So you can see that Bitcoin is actually year to date outperforming the Nasdaq. They're pretty much toe to toe, but at the end of the day, Bitcoin's just above where the Nasdaq is. Now, there's one thing I want you to notice here though. When the Nasdaq sort of goes on these big time downwards moves in a really short amount of time, Bitcoin usually, the crash is more severe. And likewise, when the Nasdaq starts to recover, Bitcoin's recovery is usually stronger than the Nasdaq. Evidenced by, right here in January, and then this recovery that we saw from March into, basically through the mid to end of March. All right. So we're seeing that these two are toe to toe right now, down 20% and down 21%. And at the end of the day, this is what we're going to be watching. People have made a ton of profit in tech stocks ever since March of 2020. And, really, realistically, you could go back way farther than that. They've been making a ton of money in these tech stocks basically for 10 years now. We have not seen and this is something I keep saying, we have not seen a true bear market in the general economy since Bitcoin has been on exchanges. So that's what I keep warning people about. If there is a sell-off in the general stock market, and I think this is going to be important, money flows like this. It goes from people make money in stocks, then they put it into Bitcoin, and then from Bitcoin, it goes into altcoins. So the money moves from, less risky to more risky to highest risk. And we've seen that now the market is sort of retracting, and there's a lot of fear that we go into a recession from here. And if that happens, where is this money going to come from that goes into Bitcoin? Where do you think people are going to be diving into the most risk on asset that's out there if we're in a recession? And then, we've seen, let's come over here. Let's go look at QQQ. So this is Nasdaq that we're looking at here. Let's go look at the year 2000. And I'm not saying this has to happen, but it's just a perfect example. If we are doing this in the Nasdaq, if the Nasdaq is plummeting like this, so up there, about 83 to 85% we lost in, the tech side of the industry. Bitcoin is behaving like the tech industry. And this happened now over 20 years ago. Events like this happen somewhere between every 20 to 30 years. So on multiple fronts, it's not the most unrealistic thing that you've ever heard of that something like this could happen again, especially when we go, we just come right back to inflation plus supply chain issues plus global conflict plus more supply chain issues plus Fed raising interest rates, pulling money out of the economy, etc. So none of this, guys, is to say this has to happen. None of this is to say this has to happen. But I'm telling you that if you're in a situation like this and tech is getting hit like this, people are not moving in to Bitcoin. They're just not. It's not going to happen. It's not how it works. Okay. So let's come over here then. Let's look at this DXY. Don't even call it DXY anymore. Think of it as the risk off metric. The higher this goes in general, the more risk off people are going to be. Or, okay, they're not risk off because this is going up. This is going up because they're becoming risk off. You can think of it like that. They're fleeing what they perceive to be riskier assets, riskier global assets, and they're coming into the US dollar. Because regardless of the narrative that you hear every single day in the crypto market, people still perceive the US dollar as being the risk off currency. All right. So this narrative that we hear every day about, fiat's garbage, it's going to zero, fine. Maybe if you want to look at super long-term timeframes, but in the foreseeable future, the US dollar is going to remain the global reserve currency. Okay. So when you see this going up, like we're seeing now, and we've laid this out a million times, so I'm not going to do it again. When you see it going up like this, and if you see it break some of these resistance levels, like, this is a serious resistance level here. 1, 2, we've been there. 1, 2, 3, nearly 4, 5, and then, right around this level, 6, 7, 8 times. All right. So this 103 up to around, 105, 106, this level has acted as a significant support / resistance level over time. All right. You saw it act as support here, sort of got a bounce off of it here, sort of, got a bounce here. So this is a prominent level. And if we break above this level, and this starts, just really going parabolic. Look at the last time that happened back here. So we broke above that resistance level in January of 2020, hit it as resistance in July. So the writing was kind of on the wall. And right in January, so January right here, we started seeing this chop up and down. So we went, from 95 down to 80. So fair size corrections. But then people thought, okay, the rally's back on because we just kept going up from there. So we went from around 83 all the way up to our high at around 125. And from there, it just crashed. So the market acted in an irrational manner for, several months. It didn't crash realistically until here in March. So you had 4, 5 months where in spite of all the strength you were seeing in DXY, you started in October, it started making its move up and then broke above in January. In spite of all of that, you still saw tech moving up in the face of, an obvious turn to a risk off attitude in the markets. That's kind of, what we need to watch for. You could still see the market still could rally from here. Just because we're telling you that, things aren't looking so great right now doesn't mean the market can't turn right here and rally. Let's take a look at the sell volume that we saw today. And I'm just showing you right here. We haven't seen sell volume like this. You have to go all the way back to 2011 to see the last time we saw this kind of sell volume. So it's higher volume to the downside than we saw in 2018 at, multiple points in 2018. It's higher than we saw at the COVID capitulation event, etc. So this was, we've been seeing some significant downside sell volume. So just huge volume to the downside. Now, I've accentuated the red candles here so that you can identify, or the red bars here so that you can see these better, so they stand out a bit more. But you can see that we have not had, volume to this extent. You literally have to go back here to 2011. All right. Now, that's not always the best indicator, but it's also typically not a good sign to be seeing some of your highest volume that you've seen in about a decade to the sell side. All right. So these are the primary things we're watching. In addition to the fact that we see that, active addresses still looks weak. There's not a lot of retail interest. There's not a lot of institutional interest at this point. I mean, look, the price is, just continuing to fall down. We're heading down to 36K. If we start dropping below, if you start getting below this trend line, I think you may see a sort of move back to the upside. But overall, I think it's going to get ugly. Now, with all of this said, I'm not here to try and tell you exactly what's going to happen because we never know. July taught us that anything can happen for at least a short amount of time. And when we say short amount of time, we're talking months here. We're never talking days. I don't give a crap what happens over, a 1 to 2 week period. Doesn't matter. Doesn't matter at all. It has nothing to do with my time frame. When I say short term, I'm talking months. When I say midterm, I'm talking, 1 to 2 years. When I say long term, I'm talking market cycle to market cycle. So in the short term, anything could happen. We saw that here. I don't know if this was manipulated. I don't know if this was, we know that China was banning crypto in November, and I guarantee you Chinese billionaires knew that in front of the actual, the actual order coming down. And so was it coincidental that we saw the market rally like this without all of these traditional metrics that we typically need to see? And that, I don't know. I don't know, but it would be interesting to see, look at the data for that and investigate whether this was a sort of a manipulated move to the upside from, Chinese big time players that wanted to get out of the market, but also get out profitably. So there's all the potential in the world that that was the case, because all of the metrics we typically see accompanying a move to the upside, like we said, they just weren't there. So overall, guys, what I'm saying is, I know, it sucks to sort of have this kind of price movement where we're sitting down at 36K. Everything looks dire. And quite frankly, in my opinion, it kind of is, or has the potential to be. Now, like we said, the markets could act irrationally. And that's why, people are probably sick of hearing this, but it's why I'm dollar cost averaging into the market, because I don't know when the market's going to turn around, and I don't really care. My time horizon doesn't, it's not influenced by these moves. This move right here is a small move as far as I'm concerned. 135%, that's a small move. That's not why you get into crypto. Crypto, you take on too much risk to be worrying about moves like that. The moves that, you should be worrying about are acquiring in these zones, acquiring when, everyone else is panicked and they're out of the market. And then where are you selling? Well, you're selling in these zones. Notice I'm not putting it up at the top because you're not trying to time the top. That's not what you should be doing in this game. Your goal as an investor is to be safely getting in when everyone else is panicked and then safely getting out when everyone else is euphoric. So that's going to be it for this one, guys. Until next time, as usual, see you.